Hi, I'm Keith McCullough. I wanted to give you an update on the Fed post the Janet Yellen decision to go dovish. And again, it's dovish, dovish, dovish. After going hawkish, then dovish, then hawkish, then dovish. Again, to review, she raised rates in December. That's hawkish. She pivoted to dovish when the stock market went down in March and April. She then decided to go hawkish in May at the Harvard Club, and now here she is in June going dovish. Why did she go dovish? She downgraded her view on the U.S. economy via labor. Why is she downgrading the U.S. economy via labor? Because she's a labor economist who gets it at the end of the cycle, and she's late on a late cycle indicator called labor. So we'll just show you that quickly here when we look at non-farm payroll growth. What happens 100% of the time, as we say, that's a very good back test at Hedgeye, 100% of the time in U.S. history, growth has always trended to negative after peaking. So again, non-farm payroll growth peaked in the first part of last year. Again, that's why we highlighted on that chart. And then point number two, if you want to zoom into what Janet calls her change in labor market conditions index, up until most recently, she called this her favorite index up until it obviously went red. And as you can see on that, we're now into the fifth consecutive month. Actually, if you update that box in the right corner, the most recent report was minus 4.9, which was not only the fifth consecutive month of slowing in Janet's favorite market labor index as a leading indicator, but it's also the worst number we've seen since 2007. So she should have been dovish the whole time. That's the point. The market's got this right. Certainly the bond market's got this right. That's why a lot of our clients are getting paid. They're long the long bond. They're long anything that looks like a bond. They're long utilities, for example, things like REITs, things that have yield, because as growth slows, bond yields fall, and yield proxies or bond proxies basically get paid. So again, how we go from here is quite interesting. What you get is that the dots are down, obviously, so they take down their projection. The dots go down, the dollar goes down, rates go down, and they hope they can keep the dollar down. Now, traditionally what has happened here is that the Fed can't keep the dollar down for long. And if they can't, I'd be quite concerned about that because, of course, what dollar down when it stops happening does is it goes up. And if rates are going down while the dollar is going up, you get a deflation of the thing that the Fed is really trying to protect, which is, of course, asset prices. Don't confuse yourself any other way. This Federal Reserve is not trying to protect the American people and their cost of living. They are simply trying to keep the S&P 500 and multiple asset class bubbles that they inflated and made bubbles, that's why we call them bubbles, they are trying to keep them intact. That is becoming more difficult to understand. And for a guy like me who came in today actually leaning a little longer, because I get what she was going to do, she was going to go dovish, that makes me a little bit more nervous. That's why I'm leaving now. Have yourself a good day.